Hey guys, today we're going to talk briefly about unearned income. What is it? Why you need to know what it is? Stay tuned. Hey guys, so today we're going to talk a little bit about unearned income. This will be a brief video. Stay paying attention because I'm going to come at you fast and hard. And the main thing is with unearned income, the question that you have to ask yourself is, are you paying more in taxes than you need to be? The answer is maybe. I don't know you, but maybe you can relate to some of these situations. So I'll give you an example. Let's say you have a non-retirement account, such as an individual account or a joint account you own with someone else. This might be invested in the market somewhere. And your idea with it being there is that it's going to generate you a return or some growth over time. Now, when going to file your taxes at the end of the year on your income tax return, in typical fashion, you go and you collect all of your tax documents from the different places that are either mailing them to you or emailing them to you, and hopefully you've gathered all of the different accounts and their information. And then you take these to, most people go to an accountant of some sort or a tax preparer, and they file all your taxes and do all your things, and then you sign the form and either maybe get a refund of some sort, or maybe you're one of those people that has to pay in some money to the Treasury. And this would just simply be an underpayment of taxes owed that you weren't withheld or hadn't accounted for throughout the year. What you may not be paying attention to is that for most people who are saving and investing for their future goals into these different accounts, there's gains and or income, dividends in particular, that happen within these accounts throughout the year. And this is non-individual retirement or Roth individual retirement, so Roth IRA accounts. We're not talking about those. Those are deferred for later. These are the liquid individual or joint accounts you may have, okay? And typically what happens when you have growth or turnover or dividends or things in there that are giving you that, anything that would be normally pushed out to you in the form of income or these dividends is simply reinvested. Typically it's defaulted that you're just going to reinvest that stuff because that's part of your growth number that you have in the account throughout the year. But unfortunately, we can't avoid reporting those gains and dividends. They still flow through to you in the form of that tax form, right? The typically 1099 is a typical form you may have seen. And these are accounted for each year on your taxes. So how do you avoid this? How do you avoid maybe paying taxes at ordinary income rates, right, on this money that you never actually got? It's stayed in your investment account. So there's two examples I'll briefly share because I think stories tell a lot. The first is I had a client who had a considerable amount of money in what we call high-yielding corporate bonds, okay? Don't need to worry about what that means. Other than that, it was kicking off a very large dividend to him every year. Now, that dividend was 100% reportable on his taxes, but how he had it set up was he kept reinvesting those proceeds from that income back into more and more shares, i.e. growing his account value. But what happened was he was paying about 40% of what he was receiving in taxes every year out of his own pocket, out of other savings or his checking account or what have you. And he didn't put two and two together until I approached him on it. And what we ended up doing as a strategy, again, which may not fit everybody, you have to look at your own situation, but we moved him to more conservative municipal bonds. Again, don't get caught up in the names, but we moved him to a more conservative portfolio that net of tax ended up being more return. So somewhere out there, there's people who are investing in these types of instruments, not knowing that the income side of it could be hurting them on their tax filing. Another more common example is, and this is more so the case, you have an investor out there who's been a good saver, keeps saving into these mutual funds or other like investments, and these funds have turnover and that throughout the year, giving off that income and those dividends. And incidentally, they get that 1099 every year, and they have no idea, right? It's just, oh, this is a tax form. I'm not quite sure what it even is saying. I'm just going to take it in because it says it's a tax form. I need to bring it along. Well, when they decide to take that money instead and move it, when appropriate, to a tax-managed strategy, meaning the manager is going to manage it differently. Okay, so throughout the year, they're going to look to harvest those gains and offset against the losses in the account to ideally keep the taxes or the taxes owed much more minimalized because they're paying attention to this, right? So we've seen it and this is just some of the studies out there, where you can have very little to no taxes owed in one sort of growth model because it's tax managed. And in the other account, you may have 8% of the value that you have to pay taxes on. And if you're paying taxes on it there, well, that's just eroding how much return you actually were able to get on your overall assets, right? Because if I maybe made a certain percentage here, I'm still paying it out the door to Uncle Sam through my own pocket, through my savings or my checking or whatever I had to pay on my taxes. And if I didn't have to pay in, well, that might just mean I had a smaller refund than what maybe I should have got. So something to really pay attention to. And where do you find this? You know, if I'm looking at a person's situation, and depending on what you have going on financially, you can find these values on your 1040. So you go and you look at your federal tax return. Typically on the first page, line 7 through 8, is going to say how much you had in unearned income. Now this could be income from rental income, or maybe you're older and you already have IRA money or pension money coming to you, or Social Security. That's all going to be on that unearned, meaning you didn't go and work somewhere to earn it. So be careful. Maybe it's not all from these potentially inefficient investment accounts. Also, you can look at Schedule 1 on that 1040 if there is any like itemization of where all that income came from. And if you need help looking at any of that, you can talk to your accountant, or certainly we can take a look at where there might be room for improvement in your ongoing financial decision making. So these are just a few examples of where a little tweak could save you in the end, potentially, from paying unnecessary taxes. And of course, you know, past performance is no guarantee of any kind of future results or taxes, nor is anything that I mentioned today really right for any of you, depending on your unique situation. So it bears repeating that you have to really take a look at what makes sense for you and make sure you're making the best financial decisions. And what we're really hoping to continue to do is guide you out of uncertainty, out of confusion, towards confidence in your ongoing financial decision making. So with that, I thank you for your time. If you found this valuable, please share this with other people. And there's some buttons below in the video. Do what you want with those. And until next time, keep taking control of your financial decisions. Thanks.